Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Well, hello, everyone. Welcome to another episode of the Live Big podcast. Today, I'm welcoming Megan Aller with First American Title. Megan is a title rep in the Denver Tech Center and Cherry Creek, South Denver area. And the reason I have Megan on today's podcast is she has one of the most comprehensive market reports I've ever seen. She comes out with them. You send them out weekly? Is that right, Megan?
So I do. I have 4 different reports that I publish. There's one that comes out weekly, 2 that come out monthly, and then 1 that comes out quarterly.
Okay, perfect. So her eyes are always on the market. She always knows what's going on. I think you also do something with Nicole Ruth as well. Don't you guys do like a monthly? Yeah. What is that? Tell us about that.
A weekly webinar every Thursday at 10. We do that online and we stream it on Facebook so that you've got the weekly numbers to go off of what's been happening, because things have been changing and shifting so much lately. It's been really hard to keep up with. And it was something that was birthed from COVID. And then suddenly we had 2,000 viewers on it every week. And so it's like, well, I guess we're doing this until we die.
Yeah.
Because a lot of people that are tuning into this.
That's awesome. That's awesome. Well, like I said, her market reports are fantastic. And she really, you're just an expert in market analysis, and you're definitely, one of the more highly respected resources in our industry for that. So that market awareness that you have and that you're sharing with everybody, for that matter, is fantastic. And it's and I know we're all very grateful for it in the real estate market. So thank you for that.
Well, it's my pleasure.
Awesome. Well, anyway, welcome to today's show. Really appreciate it. Thanks for taking the time out of your day to be here. And I know, I think we got some great information for people today.
I'm looking forward to it.
Awesome. Well, the topic for today is I want to talk about the 4 stages of our real estate cycle. So in general, and also kind of how to identify them. So to start, what I want to do is kind of give a brief overview of each of these types of markets, and then talk about kind of what we see and how we identify those markets. And then we'll go into a little bit deeper dive and talk about kind of how that affects us as real estate investors, and then really how we can maybe project what's on the horizon. Because that's always what we're looking for, right? Clients are always, should I buy now? Should I wait? And we really don't have a crystal ball. So ultimately, all we can do is look at historical data and try to apply that to what's happening today to understand where we should be. So the 4 stages of a real estate market are recovery, expansion, hypersupply, and recession. And they go in that order. And it's there's no necessarily start and finish. Once you get to recession, you go back to recovery, and they just kind of keep cycling. Okay. Generally speaking, we've seen historically real estate markets go anywhere from 7 to 18 years. It's on average, we've really seen somewhere around the 12-year point. Right now, we're actually in one of the longest real estate cycles in the last 60 years. So we haven't really pushed through all these areas. And as you know, if you're really anywhere in the United States, and especially here in Colorado, we've been in a quote unquote a seller's market for the last dozen years, maybe even a little bit longer. Maybe 2009, 2010 is kind of when it started to pick up.
Yeah, 2013 is when we dropped into a hyper seller's market, where we dropped below about a 2-month supply of inventory. So I would classify it as about 2013
Perfect.
Onwards, and it's been in an extreme seller's market ever since then.
Yeah, so we've got a decade now where we're almost in that same cycle. And so I want to just give a quick overview on each of these. So first of all, let's start with recovery. So the recovery stage of the market is really defined by an excess supply of properties on the market. So it's really when we start to see properties on the rise. We see average days on market spend a little bit, have a little bit longer timelines. We see absorption rates go up and see things like 3, 4, 5, 6 months on the market, which we haven't seen in, like you said, over a decade. So we usually tend to see prices fall because our demand decreases. We end up in this situation. Sometimes we end up with some more bank foreclosures. We generally see unemployment climbing and investment properties decline. So investors start to kind of leave the market a little bit, and we'll kind of have, in this particular point of the cycle, investment properties will be at the lowest price, okay? This is also, to make it easy, this is what we call a buyer one market, okay? So we're gonna have a buyer one, a buyer two, a seller one, and a seller two, and we'll talk about that here briefly. Okay, the second part of the market is the expansion, okay? The market really starts to absorb the oversupply that we have. So all of a sudden, those 6 months of inventory cuts down to four cuts down to two, so on and so forth. Megan, what's the lowest amount of inventory that we've had here in Colorado in the last couple of years? Do you remember?
It happened last year, and we had just shy of 3,000 available homes for sale in our marketplace.
Okay.
If you compare that back to our peak in 2006, where we had 36,500 active listings available for sale. So it's been super short supply. And as of right now, we're sitting at just about 3,600 available homes for sale headed into this weekend.
That's incredible. So it's 1/10 the supply that we had about, 15 years ago or so, 16 years ago?
Mm-hmm.
And what is that in terms of how many weeks of inventory or how many months of inventory? What is that? What does that equate to?
So it's basically 0.8 months worth of inventory. And so if you want to do the rough math on that, what does that make it? About 24 days of inventory.
Yeah.
And there's less inventory at lower price points under $500,000 and more at higher price points. But overall, when we look at the entire market, it's about 0.8 months worth of inventory.
Wow. Yeah. So anyway, we start to absorb this kind of oversupply. Time on market decreases, and then investment properties start to make a comeback, and we begin to see job growth. Okay, so the expansion market is what we call buyer two. Okay, and I want to create a visual for people here at the end to understand what this market kind of looks like. But first, we'll go to part three, which is basically hypersupply. Okay, and the supply of properties on the market decreases dramatically. Okay, properties are selling fast, rents are rising, and demand for real estate peaks. Okay, so this is what we've seen really in Colorado for the last. I don't know. How long would we be in that market? Is it really since 2013? Are we talking like...
It's really since 2013. It's been 10 years that we've been in this market of hypersupply.
Yeah, that's incredible. So this is your seller one market, okay? And then the last piece is this, kind of the last part is part four, okay? And it's recession, okay? Time on the market starts to increase a little bit. Inventory starts to recover a bit, and then business and job growth begins to slow. So, and this is called seller two market. And so what I want to put into just kind of a visual is, if you can think about this on as you're listening to this podcast, if you can think about drawing on a piece of paper, just like a hump, okay? And then I want you to create a top and a bottom and then a top again, okay? And this is what our real estate cycle is. So think of it as like two side-by-side hills with a valley in between. If you were to draw a straight line across up top and chop off the top hump, and a straight line down at the bottom and chop off the bottom, seller one and seller two are where your straight line intersects the hump up top. So on the way up is seller one. Okay, so it's very difficult to time the exact peak of a market. So seller one is if you sell on the front side, prices are still increasing, but man, we start to feel like we're close to that peak. That would be what we call seller one. Seller two is as we start to go down. So we've already seen the peak and we decide to sell before it gets too bad. That's kind of seller two. Buyer one is the exact opposite of that. So if you go down that chart at the very valley, again, you're not going to be able to time the exact low of the market. But buyer one is when you go, you know what? I think we're getting close. It's time to start buying. And buyer two is after the low peak, it starts to, or the low valley, it starts to recover, and that's buyer two. Okay. So from an investment standpoint, your best case scenario is to buy during buyer two, okay, which would technically be the same price as buyer one, right? Because they're still in the same level. You just missed the bottom piece, right? So, but the difference is you didn't own it during all that time where it was down. So buyer two is where we want to buy, and seller one is where we want to sell. And the idea behind that is that whether you buy at buyer one or buyer two, the price is the same. Whether you sell at seller 1 or seller 2, the price is the same. It's just on what side of the peak you did it. So if you can buy at buyer 1, if you could buy at buyer 2 and sell at seller 1, it's the shortest amount of time of owning a property and still seeing the same amount of increase in value. So that's where your ROI returns. So where your ROI comes into play. So when we're really focusing on investment type properties, buyer 2 and seller 1 is perfect timing, right? We don't always hit that, but that's kind of perfect timing because it minimizes our property hold time. Okay. So those are the 4 markets. Hopefully you can kind of visualize that peak and valley and what that looks like. And then once you understand those 4 pieces of the market, and now that you can kind of visualize them, I really want to talk about kind of the understanding of these phases and how we can maybe identify them. And then Megan's going to get into some really a little bit more deep statistical analysis on what we have here in the Denver, Colorado market. So, Megan, do you have anything to add on those 4 markets or my visualization that I created there?
No, I think it's great. And what's kind of interesting about this fact is that this cycle actually happens on long-term and short-term bases. And so honestly, we end up seeing this happen on an annual basis here in Metro Denver, where we see peak pricing that comes out March, April, May, and then prices start to decline July, August, September, and then they tend to stabilize in November and December. And so we actually have not only these cycles that last for long periods of time, but they also happen on short annual cycles, which is important for like fixed and flip investors, where they want to pick up properties in the fall and then they want to sell them in the spring. And so we end up seeing these cycles happen in short-term and long-term cycles. And so it's kind of interesting to watch the ebb and flow over time, especially when it comes to these shorter and longer-term cycles.
That's a great point. And I'm glad you mentioned that, because it is something that if you go back and you look at like the last 10 years of data from again, the Denver metro market, what you'll see is, and it's like clockwork, like we peak every single year in June or July. Okay. And that means May and June under contracts, right? So every single year we peak in June and July. We pull back, and that on historically, and Megan, if you have a different number, please let me know. But historically speaking, we've seen in the last 10 years about a 3 to a 5% pullback in those kind of back to school months. So in the August, September, October, before we stabilize in November, December, we see a little bit of a pullback from our peaks. From what I've seen, 3 to 5%. Again, depends on your market and depends on your hyper local market. But in the grand scale, in the grand scheme of things, 3 to 5%. We see that kind of every year, and it's cyclical. It happens every year. People don't want to necessarily be moving during the back to school time. They don't want to be changing school districts as their kids are supposed to go back to school. Just getting things in order. So are those numbers in line with what you have, Megan?
The only thing that I would disagree with is when our market peaks.
Okay.
So I would say market peaks for those listings that are on the market March, April, and beginning of May. By the time that we hit mid-May, we start to see that pullback. And it's usually around summertime. And then a real harsh pullback happens right after Independence Day weekend, where we literally start to see the market become sluggish. Yep. And we start to see those prices really fall for those August closing as a result of going under contract in July. And so it's really important for you as a seller to time the market so that you're getting into the market in the spring months, and hopefully be able to do some sort of creative transactions where you're able to have you can lease the property back for a period of time to get your home sell or move in the summer months than it is in the spring months. But it's interesting to see that. But the prices tend to run up. On average, over the last 10 to 15 years, it's been around an 8 to a 9% run up in average sales price from January to June. And then we see that pullback July, August, and September anywhere 3 to 5%, which ends up with around a 6% appreciation rate on average when we start to see appreciation and when we look back historically over the last 40 or so years.
Sure. Yeah, absolutely. And I think, and again, like I said, those June and July peaks, those are closings, right? So the problem is if you see May peak, that's when we're seeing things on the market go like kind of crazy. But then when June comes around and you go, I want to sell my house, and you just notice that your neighbor's house closed at this ultra high price, it's too late because they were listed in May. So now you see their price, and now you put your home on the market a week or two later. And like you said, I've seen it as well, that July 4th, that Independence weekend, it's like a fall off. It's like all of a sudden you go from like 80 showings in a weekend in May, and then all of a sudden like it's like 12, which is still really good, by the way. But, we see.
I'm still a big fan of April transactions.
I am too.
So I think that May, specifically this year with May, my concern is with the way that the holidays fall. We've got Cinco de Mayo on a Friday. We've got Mother's Day the following weekend, then all of the high school graduations, and then we end with Memorial Day weekend. And so I think that this year may look a little bit different this year than what we've seen in previous real estate cycles. But we're also working in an environment where we have significantly higher interest rates than what we've had previously. And the people that are out there that are moving right now have to move. They're moving as a result of a death, divorce, loss of a job, getting married, having children. And so those are the top 5 reasons that people are moving in our market right now. And it's not just because I simply want to make a move, because we're focused on interest rate gridlock, where a lot of people, I think is over 80% of people, are in a home where they either have no mortgage payment or they're in a sub 5% interest rate environment. So people don't want to move into a smaller house for more money. So they're sitting tight, keeping our inventory incredibly restricted right now.
Right. And that's exactly right. I mean, we have part of that low inventory problem is you have people that they don't, why would they trade a 3% for a 6.5%? If anybody, if you owned a home in the last couple of years that you either purchased, or if you didn't purchase it, you probably refied it and got a 3.25. I know some people in the 2s, 2.75, 2.875. It's really hard to exchange that rate out, just by desire. If you had to move because of job relocation or family creation or whatever, like you said, that's different. But the people that, would normally be maybe moving up or whatever, that's putting a huge restriction on our inventory. And we were already at low inventory before this. And so that's where it kind of extrapolates. And now we've got this, like you said, 3.5 weeks of inventory, which I don't know. I remember what it kind of used to be, but what is your take on what a balanced market is now as far as in terms of months of inventory? What would you consider a balanced market to be?
So it used to be considered 6 months worth of inventory was considered to be a balanced market, but that would be a lot of inventory. That would require us to have around 28,000 total available listings for sale today in order to offset demand based off of what went under contract last week. And so I think that 6 months of inventory would feel incredibly high because we've been sitting in a market where we had less than 2 months worth of inventory for a very long period of time. So I think the balance really does occur closer to about 4 to 6 months worth of inventory, but it would feel like an absolute ton, and our market would feel incredibly sluggish because we've gotten this unrealistic idea of this fast food service of how quickly properties move in our market. They have been for the last 10 years.
Yeah, I definitely agree. The 4 months worth of the 4 months worth of inventory, I think, has to be the new standard, the new norm. And you're exactly right, because it would feel amazing compared to what we've seen over the last, like I said, 10 years or so. So, I want to go back to the point that you kind of said, where we see these markets, we see them seasonally too. Like we see them within the year, we see them within a 1 year or 2 year period, because one of the things is that we see people kind of mislabel these markets, right? Like, so the pullback that we had last year in 2022, for example, from our peak, which was really in May of last year, through essentially March of this year, right? So we had May of last year, and then we pulled back. So May of last year is when we really peaked, but people saw that and they were like, "Oh my gosh, the market's crashing." Well, not really. That was more of a correction than anything. And right, like we didn't shift market cycles, but from a mini market cycle, from a yearly market cycle, it sure felt like that, right? Like we went through. It felt like we went through a seller 1, seller 2, buyer 1, and maybe even a buyer 2 in a period of like 18 to 24 months. Because in 2021, the summer market of 2021 was unbelievable. I mean, it was just the craziest market we had seen. We felt like it was the peak. Things were going nuts. They started to slow down a little bit towards the end of the year. And then they absolutely went even crazier in the beginning of 2022, right? Like, so for the first 4 months of 2022, it got worse.
Yeah, when interest rates started to go up, it acted as a big catalyst in our market to get buyers that had been sitting on the fence off the fence and into the market. And buyers were picking up pretty much anything that was listed at that point in the first 4 months of 2022.
Right, right. And so it felt like, and then what happened? So we ran up. So seller one, and seller one was basically the prior year of 2021, and then at the beginning of 2022. Up through basically May was our peak. And then seller two kind of took place right after that, but it was real short. It was a couple months. Like if you didn't have your property sold by like July or August, you were in for a big hurt, because now all of a sudden those interest rates were climbing up. So we saw seller one in summer of 2021. We saw peak in May of 2022. We saw seller two basically 2 months after that. And by December of that year, December of 2022, we were in this like what I would consider to be a buyer one market. And I still think we're a little bit in a buyer one, buyer two, somewhere in there, but we're seeing that climb again. We're seeing that growth again, right? I don't know. You're going to know better than me on this, but growth since the beginning of the year, what are we up so far this year? 5% this year, something like that?
So there was a real lag. And so there were a lot of listings that came to market, not a lot, but seasonally a lot of listings that came to market in November and December, and then finally went under contract in January, closing at the end of January. And so average days on market read like it was 50 average days on market, but the stuff that was going under contract in January was going under contract in a median of like 2 weeks. And so it was kind of this really interesting push-pull where we were looking at old data because it was based off of closed transactions that were actually marketed 2 to 3 months earlier, finally going under contract. And now the absorption rate was really picking up. And so it was probably by about mid-January, and really the second half of February is when the market picked up. And we started to see that transition of more buyer activity and multiple offers coming out. So overall, we ended up falling on our average sales price by, and I can actually pull up the graph here and show you or tell you about it. And so in January, we ended up seeing the average sales prices fell month over month by about 1%. But by February, they were up 4.1%. And at the end of March, we were up another 2%. So overall, we're up about 5% from the beginning of the year in terms of our average sales prices at this point.
Right. Right. And so, I mean, again, it goes back to what you said before, where we generally see this 8 to 9% run up during our high season. And then we pull back a little bit for an average of, 6-7% growth somewhere in there. And we may be on pace for that this year, but last year and this year just feel weird, don't they? I mean, just because of our where the rates are, where our market is, things just feel a little bit weird this year. And I feel like our crystal ball, it's like somebody's just kind of shaking it up, and you're like, well, what are we going to do now? Because we don't know. We saw rates start to pull back. We saw rates peak over 7 very briefly at the end of the year last year, and then they started to pull back, and we even got back into the 5s again. And then all of a sudden, we started getting oil scares. Oil production being shut down. We saw bank closures, which actually that helped the rate market. But then a couple weeks later, we're back in the high 6s again, right? And so I feel like it's hard to know right now. What are your thoughts on, the volatility of what we're seeing in the rate market right now?
Well, I think that until we get inflation under control, we're still going to continue to see volatility in the marketplace. We've been waiting for this looming recession to come out and take hold, and for someone to come out and actually announce that we're truly in a recession, but we continue to spend like we're not. And consumer spending is actually up right now. And so the likelihood of us getting inflation under control without higher interest rates just isn't very likely. Our job markets are incredibly stable, where we only have about 3.6% unemployment right now in Metro Denver, which is also historically low. And unfortunately, it seems like Powell's going to have to hold interest rates higher for longer in order to tamper inflation. There was a lot of talk earlier in the year about a May 10th release date for inflationary numbers that would hopefully bring rates back down, but I'm not convinced that we have inflation under control yet, and that we're going to see interest rates come down this year. I think it's going to be next year before we start to really see rates dip again.
Yeah. And I agree with that. Again, like the piece is, by the book definition of recession is that we should be in recession, right? That we have two consecutive negative quarters of GDP, which we had last year. And so by book, we should technically be in recession, but all the other signs point in a different direction, right? Like signs of recession show that job growth is slowing and people are losing their jobs and unemployment rates are going up. But we've got more jobs available than we've ever had. Last year, I think towards the end of the year, we had something like nationwide, something like 10 or 11 million jobs available. Like you said, unemployment rates just here in Denver, what did you say? There were 3.5% or something like that?
3.5%.
Yeah. So 3.5%. And ultimately what it comes down to, so even though the numbers show recession, you're exactly right about the fact that part of what recession is supposed to do is it's supposed to keep people from spending money. And the idea is that recession is, I think, in my opinion, is really guided by consumer confidence, for one, and then just, so consumer confidence, I think, is the thought process that, if we are, for example, for people, their ability to keep their job, right? So like if they feel, am I going to have my job? Am I going to continue my earning power? And when people see jobs, people start to get laid off and people losing jobs and there's no jobs to pick up out there, people get a little bit more tight, right? They go, well, we need to start thinking about our spending and we need to, be careful because there's no, but people are walking out of jobs left and right now, right? Because they know they can walk down the street and go get another job. Like there's tons of jobs, right? And so you have consumer confidence, and then you also have consumer sentiment. And the consumer sentiment is the piece, again, where it's how we feel about our wallet when we pull it out. Like, should I be spending money today, right? It's like, and you're exactly right. People have not put their wallets back in their pockets yet and curb their spending. And if you don't do that, you can't curb inflation because everybody's just increasing their prices because of inflation and we're still paying it. Okay, once we decrease the demand of whatever it may be, right? Whether it's food or clothes or cars or whatever, once we decrease that demand by putting our wallets back in our pockets and going, hey, it's time to tighten up, we shouldn't be spending money in time like this, that's when the recession will really take hold. And that's where Powell will be able to bring the rates back down. But until then, people just keep spending their money. We have more debt. We just did a podcast on this a couple of weeks ago, but we have more debt, more credit card debt than we have ever had in history. Okay. We have more, like we just passed $1 trillion in credit card debt as in the United States. That's insane.
Yeah, I also read an article about how bankruptcy filings are up 20% year over year at this point because we're not like we have to stop spending money like we run a drug cartel in order for this recession to come about and get inflation under control. But people haven't stopped spending. They've gotten so accustomed to it over the last 10 years that they're not putting their wallets away and saving when they're supposed to be.
Yep. And we really, in order for this recession to happen and get through it, we just have to embrace it. Like it has to happen, right? But being on the verge of inflation is worse than on the verge of recession is worse than being in a recession. Like being in a recession is really not that bad. It's a recovery process for the economy. And so it's really, I don't know, it's a struggle for me when I see the amount of spending that goes on and that like we just need to find a way to put our wallets back in our pockets, hold off a little bit, let this thing, do what it needs to do, because we get in this situation that we're not going to see rate improvements because we can't, because us as Americans continuing to go into debt. The bankruptcy thing is crazy to me, like that much bankruptcy. And this is literally comes a year, 2 years after the government was just sending people free money and people are still going bankrupt. Like, and part of it is because I think that's a part of the reason for it, because it enabled spending, right? People were spending that extra $1,600 a month or whatever was being sent to them. And then all of a sudden when it clicked off and they're like, okay, no more COVID relief. The reality is I don't know what percentage of Americans were getting relief checks, but it was fairly high. And honestly, only something like 10% of people lost their job due to COVID, right? And so yet 60, 70% of us were getting checks. So we were all spending that money because it was like, oh, it's extra money. Like, let's go use it, right? But the relief went to everybody. And so all those people that maybe were living paycheck to paycheck and they were like, man, this is great. I got an extra $1,600 a month. Instead of saving it, they're spending that money and thus increasing their living habits. And then all of a sudden that check falls off and there's no more of that extra income. And now they're used to living this lifestyle and they just basically took a $1,600 pay cut. I don't know about you, but most people don't have the ability to take a $1,600 per month pay cut.
No, they certainly don't.
And so when you do that, it's you enable this behavior, and it spirals us as an economy. So it's a really touchy subject, because I know that money was really important for a lot of people and helped a lot of people through tough times, but it also created some problems here on the back end.
It sure did.
So
sure did.
Yeah. So anyway, I love that conversation. I love talking about that kind of stuff because I don't know the answers. I don't claim to sit here and know that we should have done something differently. Like I don't claim to be an economist or, a philosopher or anything like that can, create this utopian, society. But I don't know the answers. I just know that everything we do, every choice that we make, everything that happens, there's a consequence to. And I think we're experiencing some of those. So, cool. I think I want to move to the last piece, and I would love to get because this is your expertise. I would love to get your take on our current market. And what I'm going to do for those of you listening, we're going to do a screen share so you can pop us up on YouTube and catch this too. So you might be able to see some of the graphics that Megan is going to share with us. But Megan, I'd love to get your outlook on where you think the market is and where it's going, and maybe what data you have to support that.
Sure. So we're really in the peak cycle of our market right now, where if you're a seller, this is the best time to be a seller. It's during the month of April. I would avoid Easter weekend, but the rest of the weekends should be good for buyer activity as we start to get into some of our months. Again, I think that May is going to be much more distracted with all of the different holidays, and I've already listed out for you where we're going to start to see more of our buyer demand peter out. Every single year, we go through a compression and a retraction cycle that we've already talked about, where we start to see prices going up from January through June. They fall back July through October, and then they tend to stabilize October, November, and December. And so we're seeing our compression cycle where we go through January through May, I think is actually going to be shorter because we have a smaller group of people that are moving and listing right now. And those people that are moving and listing right now, there's not as many transactions happening. We're down about 20% in terms of total transactions year to date versus where we were 1 year ago. And so I think that our compression cycle, where we see that big run up in prices, is probably going to start to taper off by the time that we get to May. So if you're a seller, you definitely want to be in the market in April. Now, getting into May, different timeframes, we're still going to have a good market, but you may have to take concessions on your pricing strategy a little bit by like 1 or 2%. But by the time that we get past Independence Day weekend, we really start to see prices falling at that point for those buyers that came late to market that now want to move, that now have something under contract, or they had a construction piece that they were waiting on. In order to get that timing right in the market, you're going to be down by about 3 to 4% at that point. By September, you're down 5%. October, November, and December, we end up seeing a purge of expired and withdrawn transactions. And so we see fewer new listings making their way to market, plus people choosing to pull their listings from market in favor of waiting until next spring. And so we'll see inventory driven back down again as we get into October, November, and December. Well, our buyer pool doesn't taper out quite as much, so prices tend to stabilize at that point. When everything is said and done, we're not going to hit the same types of highs that we did in 2022 and 2021. At the end of the day, when we go through and we average together all of 2022, we still had like an 11.4% appreciation rate. As of right now, our average sales prices, when we compare the same month now to 1 year ago, are down by about 5.6%. So I think that by the time that we get through this entire annual cycle, I really do project that our overall annual appreciation for this year is going to be down by 2 to 4% overall when we average out the entire year. And so again, it's just due to that hyper frenzied market that we had for the first 4 months of 2022 and not necessarily the result of the falling prices that we saw previously. But if you look at the short term, even though our average sales prices are down year over year, they're still climbing on a monthly basis. And so we've got this really interesting cycle within a cycle that's happening right now that we really have to pay attention to. But again, the types of transactions that I'm seeing happen right now are the ones of the people that have to move, not the people that want to move or they want to get a larger house. So they're choosing to wait in hopes of having a lower interest rate environment next year rather than this year.
Yeah. Do you feel, do your opinions, first of all, are these the kind of the crystal ball that, again, and I don't want to call it a crystal ball because this is statistically driven. Like
the magic 8-ball. Let's call it what it is.
I'm so supportive of the fact that like these are. I'm a very analytical person, right? And I think I don't like gray area, right? I like it to be one way or the other. So I
right.
I know,
and I want to be researched, and I want to be right.
Exactly.
And I want to know that I have the right answer. I don't want to be right for sake of being right.
I agree.
I want to be right because I did my research and I know what I'm talking about.
That's right. So let me ask you this: does that evaluation of our market change? I mean, I think this is a loaded question, but does that evaluation of our market change should we see significant change in rate structure?
Yes, I think it does. If we end up seeing rates go down to the 5s, that could change and shift demand right away, and we could see an extended selling season. Again, I just don't feel like it's going to happen this year because I don't think it's going to help us curb inflation anymore.
Yeah.
And it's only going to make matters worse. This recession is necessary to go through and reset values across the board. Yeah. And so again, I don't think that it's going to have a huge impact on home values because in the last 8 recessions and only one of them did we actually lose home value. Recessions are actually good for the real estate market where we end up seeing rates drop and more buyer demand come out. And so it could be a really interesting play if we finally go into a recession to see that we have interest rates come down. But when we looked back at what the Federal Reserve thought was going to happen into next year, we were expecting that rates would be closer to the 4.5% to 5.5% range next year over this year, really pushing interest rates to higher levels to curb inflation.
Right. And, I say that because I think it's funny. So last year, about a year ago, I think probably in March or April, I was interviewed for a Wall Street Journal article, and I'm going to say this, but I'm a little bit embarrassed by it because I was wrong. My crystal ball was wrong, right? And so, but part of what I spoke about in the Wall Street Journal was the fact that people that were waiting around, essentially, the people that hadn't gotten off the fence yet and taken advantage of 3% mortgage rates or whatever it was, like they were in for a rude awakening. Like we, at least in Colorado, for example, didn't have the inventory to support any type of downfall of the market come anytime soon. Well, then we experienced mortgage rates doubling in a matter of 3 months, and I basically had my foot in my mouth at that point because I was like, okay, well, I didn't know we were going to, and I don't think anybody could have predicted that type of rate increase last year. Like we knew that it was going to come to a head at some point, and we knew that rates had to rise. But man, going from a 3 to a 7 in a matter of like 6-7 months was really, really brutal. And so, yes, we saw the market fall off, right? And we saw things pull back, and it was that kind of correction that we talked about. But at the same time, like, had you bought a house, let's say in November of last year at a 10% discount over May, if you were mortgaged, your monthly payment was probably still more, right? Mm-hmm. In fact, not probably, it was still more, right? And so, well, I guess that depends on your price point, but the reality is that it was still all about the monthly payment. So you could have paid this massive amount for a property back in April or May of last year, but you had a nice 3.5% interest rate where, maybe you saved $100,000 or $50,000 down the road, but you were paying 6 or 7% on the rest of the property. And so it made the argument could still be there, which is like, hey, yeah, you got a great deal on your house. You get, $50 grand less than your neighbor paid, but they still have a lower monthly payment. And so, that's one thing that's hard about this market is like, we can predict all we want that, the spring market is like the best time. But man, if rates get back into the 5s, 4s sometime towards the end of the year, we're going to see a pop again, because all those people that missed the 3s or the 4s and then saw it run to 7 aren't going to miss the 4s and 5s again. They're going to be like, okay, it's time to go, And so I think it's all relative to that. But in general, I mean, all else considered equal, if we just kind of stabilize the rates, like I agree with you. And I do think that, I agree with you that I think our rates are, maybe we see some improvement in rates, Q4 or Q1, Q2 of next year. The only caveat to that, and I think this is for another time, this is for a different podcast, but looking at the banking crisis that we're potentially in, with the inability of banks to buy and sell bonds the way that they need to sell, and that's the reason why the Fed has to drive rates back down, is because the banks can't equalize their positions. And it's amazing the economic impact that rates have going in either direction. So anyway, well, great. Do you have anything else to add to that?
No, I think you covered everything. Great job.
Cool. Well, hey, I appreciate your time again today. It's always nice I love reading your reports on a weekly basis, and it's always something that we share with our team and that we send out to our office. So keep it up. We really appreciate that, and thank you for being here today to help educate the listeners and give us your outlook.
Of course, it's my pleasure. Thanks for having me.
Awesome. Well, that is it for today. Hope you will check us out again next week, and make sure to go to our webpage, www.blackyettigroup.com. Go to the resources tab for the rest of our Live Big episodes, as well as our free resource guide for our investment partners and people who are interested in getting into investment real estate. Download the free resource guide there, and continue to check us out every Wednesday on your favorite podcast player. So hope everybody has a great day, and remember to go out and live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyettigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.